Hello, everybody. Welcome to the eighth episode of Economics for Prelims. And because we have finished fiscal policy, now we are going to discuss about external sector. So, under external sector, we are basically talking about two accounts here: current account, capital account. Current account will basically have all those transactions that are recurring in nature, and compared to capital account, the amount that we are talking about here is the money that we are transacting here is basically of a small denominations compared to what compared to capital account. So you basically have those activities which are like ongoing or recurring, like for example, import, export, factor income earned from abroad and non-factor income. Factor income earned from abroad and all will include basically what your profit, the wages, all of that. Non-factor income would include banking, insurance, shipping, tourism, etc. And then you have transfer payments. Transfer payments, when we say, we are basically talking about gifts, remittances, and then grants. Clear, people? Now, a beautiful table is given in NCRT textbook, Macroeconomics, last chapter. Please go through that once to get a more detailed breakup of how current account comes. Then you have what? Capital account. Capital account, when we talk about, we have FDI, FII, loans, multilateral, bilateral aids, etc. These are the things that comes under capital account. Basically, anything that brings in capital into the country. Clear, people? Now, basically, the balance of payment. Okay. Current account and capital account basically belongs to what? The balance of payment, current and capital. And current account plus capital account together should be what? Zero. Current account plus capital account together should be zero, which means what? BOP is always zero. Balance of trade, when we talk about in terms of what? Imports and exports, this can be what? Negative or positive. So in the case of, let us say, between USA and India, we have a trade surplus with USA. We are exporting more to USA compared to what we are importing. But in the case of China, we are having a balance of trade deficit. Clear, people? Now, if the current account deficit is high means, then what will happen? That means what? You're importing more than you're exporting. That means dollar will be in more demand compared to rupee, leading to appreciation of dollar and depreciation of rupee. In such a scenario, with appreciation going on happening for dollar, who will intervene now? RBI will intervene through the official reserve sale. That is, RBI will sell dollars from forex reserves. From forex reserves, RBI will take the dollar and sell it into the market. Next thing is what? How else can we deal with current account deficit on a sustainable basis? By improving the exports, by improving the remittances, as well as increase in FII. Clear, people? Now, FII versus FDI. Now, FII, when we talk about FII, is generally told that it is hot money. Why? Because it can come and go anytime it wants. Whereas FDI, when we talk about, it brings in what? It brings in technology, it brings in a lot of employment, and needless to say, the capital here is more permanent nature compared to FII. Now, FDI again, if you see, you have greenfield investment, brownfield investment. Greenfield means what? 100% from scratch, and a foreign investment is coming, setting up their industry, their business shop, etc. Completely new it is, like Amazon. Brownfield means an existing enterprise or a building is acquired, and on that business, you are building up your business now by acquiring the place that is existing. Already something was in existence, and you have acquired either partially or fully. Clear. Then we have two other concepts called ADR, GDR. Now, what do you mean by ADR, GDR, etc.? That I will explain to you in episode 9, where we will be talking with a few more terms and terminologies associated with external sector. Clear, people? All right. And before that, before we wind up our class for today, let us try to understand fixed exchange rate, floating exchange rate, managed floating exchange rate. So fixed exchange rate system was initially used, under the Bretton Woods system and all. Exchange rate was used in the sense that dollars value was fixed with respect to what? Dollars value was fixed with respect to gold. But that system we have done away with. A completely floating exchange rate system means the value between two currencies is determined by demand and supply. No intervention from government, no intervention from RBI. Managed floating exchange rate is what? It is little bit of both. You have the forces of demand and supply. Along with that, you also have intervention from RBI occasionally. Why? To prevent excessive appreciation of rupee or excessive depreciation of rupee. Clear, people? Why are we doing this? Excessive appreciation of rupee will increase the imports. Excessive depreciation of rupee can actually increase the cost of imports. Appreciation will encourage imports and discourage exports. But what is the real drawback because of depreciation of rupee? The cost of imports will increase, especially gold, coal, crude oil, and electronics. Clear, people? So this is the idea here ultimately. And what system we are following? We are following managed floating exchange rate, otherwise known as dirty floating. That is, if too much of fluctuation is there with the value of rupee, then RBI will intervene. That is the idea here, people. Clear? So with that, we come to an end of external sector also. Hope you understood this. All right. Now, happy studies. More topics will be coming online where we'll be discussing it under the head of miscellaneous. Okay. Under miscellaneous head, we will be discussing the other major important topics. All right, people. Happy studying, people. God bless. Take care.